First, I want to welcome everybody to this panel discussion, Passive Investing Exposed, the Anatomy of the Deal. I'm thrilled to see such a great audience. Before we jump in, I want to just ask everybody, if you can, while we're going through this, share where you're from. I'd love to know where everybody's dialing in from. While you're doing that, I just want to take a moment to just send our thoughts and prayers with Steve Hatcher. He won't be able to join us due to the death in the family. Our condolences are with you, brother, if you're watching the recording. Today, we're excited to bring together a group of experts to pull back the curtain and demystify the world of passive investing in alternative assets. While most of what we will talk about relates to our bread and butter, real estate, a great deal of what we will discuss applies to any type of investment. Believe it or not, this webinar has been in the works prior to the financial market turmoil that we've experienced over the last few months, including the recent headlines in banking and real estate issues. Although each of us also operates an investment firm, our goal today is simply to provide you with the value of the combined experience as investors, first and foremost, and hopefully arm everybody with some good gold nuggets to help us all make better and great investment decisions. I personally am excited to be sharing the virtual room with these rock stars in the investment world. I have some questions prepared to get our conversation going and tackle some key topics that we want to cover. But the expectation is to take the conversation wherever it goes and make it as impactful as possible. We'll have an extended Q&A of about 30 minutes or so after about 45 minutes of discussion. So use the chat along the way to ask questions. It is being recorded, so understand if you have to drop, no problem there. Just you can ask your question anyway, and we'll answer it, and then you can watch it on the recording. One disclaimer I want to get out there and request relative to conversations in the chat. We are aware of the many headlines and stories of challenges some sponsors have been having of late, but we're not going to be in the business of naming names or otherwise bashing any firms that we don't have any experience working with. If you have any questions related to any of those topics, we'll feel free to, we'll touch on anything, providing that there's some factual knowledge. So sit back, relax, let's get ready to delve into the program. All right, so first, myself, I'm Sergio Altomare. My company is Hearthfire Holdings. I've been a real estate and an investor back since 2004, where I bought my first multifamily property. Along the way, have invested into many direct deals myself, side businesses, startups, and you name it. Spent a lot of time doing due diligence on companies, so really kind of honed in on a lot of what we're going to be talking about. So from here, I'm going to pass the mic over based on what I see on my screen. Let's start with Hans Box. Just introduce yourself and a little bit about your experience in passive investing.
Thanks, Sergio, and glad to be on this panel. I'm actually honored that you invited me. So quick background on me. I started out as a CPA, and then I got into the syndication business back in 2009, 2010 period, and we'll touch on that a little bit later. And I basically am a syndicator, buy multifamily self-storage and mobile home parks, including and also invest in some distressed debt through the syndication model. And then I'm an LP in probably 50 to 60 different deals in addition to my own across multifamily, self-storage, mobile home parks, distressed debt, industrial, retail, VC, PE, land, et cetera, et cetera. So I kind of sprinkle it around. So a little bit of diversification. So,
cool. All right, Matt.
What's up, everybody? Matt Faircloth here, and located up in Pennsylvania, just north of Philly, in a little town called New Hope. Primarily an apartment building syndicator, but I've done a lot of work on the active side outside of multifamily syndications. I've done like 4 or 5 dozen fix and flips. I wrote a book on raising money for bigger pockets called Raising Private Capital, with regards to just attracting people out to invest with you out of your own network. And that conversation and writing that book and in working with, probably in the low thousands of passive investors in my career, has really taught me a lot of the passive investor mindset. and what it takes to invest in get different marketplaces. And I'm also an active passive investor with investments in syndications, both my own and other people's syndications. I am also a avid hard money lender as well. So, and I'm constantly looking at opportunities for investments in and outside of real estate.
Awesome. Thanks, Matt. Ray.
Yeah, thanks very much, Sergio, for putting this together, and thanks for the audience and being here. I'm Ray Bayat. I've been in the shopping center investment and development business since 1991. I picked that niche, and I believe I'm the best at it. But I also want to diversify my income, and so I've, as a passive investor, I've invested in debt funds for operating companies, a debt fund for real estate, a debt fund for an apartment group, sidecar loans, hard money loans, consumer debt and credit card debt. And so my philosophy is to pick the expert who has the expertise in one particular niche and invest with them.
Awesome. All right. Well, thanks, guys, for all the intros. All right. So we got some introductions out of the way. So I'm going to start with you, Hans. Tell us a little bit about your story that you've, in getting into passive investing, and, how has that influenced the direction and your investment decision just in general?
Yeah, and I think we're going to touch on like my first deal later on, if I'm not mistaken, right, Sergio? So I'm not going to go deeply into that, but I got into it by buying rental homes right after the great financial crisis. And, I attended one of those mentor groups and had a W-2 job, and getting a taste of passive investing, owning single family rental homes, which is, I don't know, halfway between passive and active investing, really. That kind of kicked off my career here in real estate investing. And so getting those checks every month or every quarter is just, it's a freeing feeling. And so once I started doing that, I got into bigger stuff like multifamily and self-storage. And, basically it is what really drew me to passive investing is the freedom it lends. So once you are able to cover your basic expenses and then able to cover all your living expenses without, cutting any, having a tight budget, it just is incredibly freeing. And it allows you to do what you want to do when you want to do it. And so as I got a taste of that, I just kept slowly growing. It just snowballs. And that's one thing I would want to, I'm probably going to say that 1,000 times during this call. Be patient, be patient, be patient. Don't try to hit a home run on your first deal that you invest in.
Cool. Matt, tell us a little bit about your start.
So, when I first got started, I invested, actively in a lot of my deals. So I had my own money in rentals, my own money in fix and flips. As I was interesting is as I invested in my business and I started to automate my business, my investments in my own business became more and more automated as I removed myself from the operations side of it. So as I started outsourcing property management, Serge, like you, I got started in, onesie twosie rentals, to forgive, the term, right? And that was, as Hans had said, kind of quasi passive, except for when there's an issue or when a tenant calls you at 2:00 in the morning because they got a problem, and so as we scaled up and our team and our asset complexity, it enabled us to go a little more passive in our current operations side of the business. Then we wanted to just diversify. And so we started out with lending to some people in our immediate just circle. My very first private loan, Serge, was a tenant that bought a building from me. He bought he had a barber shop and then a 1-bedroom apartment above, right? And he was my tenant in the building, and I needed to exit that or wanted to exit that property. So we sold it to him. And I floated a private loan to him, he brought cash to the table. And he also, this guy was running a barbershop. So Serge, he actually literally brought cash, like in a backpack. So we had to get that squared away. That's another story. But then he paid us monthly payments, very like clockwork. And I floated a private loan to him at what you would call hard money loan rates, but I loaned him $50K, right? And that's a weird number that's very hard to get from a bank, but very easy to get from somebody like me as a segue into private lending. So it was a good win-win. And I charged him 12%, which sounds like a lot of money, but that's $500 a month, right? So at the end of the day, he was willing to pay me, and I'm proud to say he paid the loan off. And that was our very first private loan arrangement. And I've become a very big fan of private loans since then. So I want to say my wife and I have, like a half dozen or so active private loans right now that are what you would call hard money loan rates. We also like to do deals where it's like a JV, where we get a piece of the upside, where we get a flat rate of return on our money. We just had a fix and flip close out in Tampa where we got 8% plus 15% of profit. So we're going to land at about 17.5% on our money annualized on that deal, because we gave him a lower amount to manage, 8%, but we got a chunk of upside. Now there's going to be a level of trust there that his books are going to be clean and everything's going to make sense. But we felt good. We've known him for years, and it was a good arrangement. So, and then other operators that are in different markets or different asset classes, we invest. To be straight, a lot of them are syndicators that have investments with us, because you don't want to keep all your eggs in one basket. So we've invested with other operators that we have a lot of trust for, and they've also invested with us. So it's kind of like a symbiotic relationship that we just diversify both of our cash with each other. So awesome. That's been our experience. My wife and I are also aggressively looking at passive businesses that have either in-house management or in-house something. Looked very heavy at the laundromat business, looked at a lot of the home repair businesses, and buying a business that's got management in place, or that I can place management into, and be like the inspiration, the mentor, and the money for something like that. So that's probably will be our next venture beyond hard money loans and syndications.
That's awesome. Thanks, Matt. We're going to get into the whole trust and evaluating when we get into the kind of the meat of this. Ray, talk about a little bit about your start and everything that you've done.
Yeah. So simply, I just wanted to diversify because obviously, as a sponsor myself, I have to sit on a lot of cash and a lot of covenants and loan documents on my guarantees and so on, that I can't have a lot of liquidity outside of investing in my own business. But the goal was to diversify. I was on a international trip with Pat Hyben, and he said he's got 60 K1. So my goal is to get to that, and my tax returns to be 1,000 pages. That's it, man.
Hans, you had 60 K1s or what?
I actually have more than that, I think, if you count my deals and my own deals.
You're my new idol now. Forget Pat Hyben.
I have to literally track it on.
All right, so let's talk about that. All right, so Hans, I'm going to start with you. Let's talk about you're introduced to an investment concept or an asset class, or however you've gotten started, right? Talk about the level of due diligence that goes into it. I know that you're pretty systematic, and in fact, I'm going to see if we can maybe take some of the passive investing materials that you've provided and maybe offer that as a handout. Throw in the chat if that's something that you'd be interested. Hans has put together kind of a checklist that I thought was really good. Maybe we can.
I think you only charge like $4.99.
Yeah, there you go. That's it.
Yep.
All right, so Hans, tell us what you look for.
Yeah, so I mean, when I'm looking at a new deal, I think the two biggest things that I look for immediately the first thing I read is a business plan, right? I mean, you got all the legal docs and the legalese and all that, and those are important to read. But the first thing I look at and I read in detail is the business plan, whether that's a PowerPoint deck or an actual Word doc or PDF or something. And don't get sucked in by it being all slick and flashy. It's really about what the content is. And the first two things I look for are the sponsor, or what I call the jockey, the guy that's driving this horse, and then I look for the deal itself, and is there a value add component? And those two things are the most important items to me. So if it's a debt fund where you're just getting 10 or 12%, that's different. There's not a value add component. You're making interest income. But if it's something like an apartment deal or a self-storage deal or anything of the sort, there needs to be a basically margin of safety built into the deal. In other words, you don't want to buy a deal that's fully occupied that you basically paid retail cap rate for, even if it cash flows, because you have one dip in the economy and the value of the deal goes down. Guess who loses their money first? You do. You didn't create any value. So the key is the day you buy it, not literally, but the day you buy it, you can add value to the property, whether that's by increasing rents, taking care of deferred maintenance, doing out, making the curb appeal look better, whatever it is to increase the net operating income. That basically properties are valued on net operating income based on a cap rate, as everyone probably knows. And so if you can't create a true margin of safety and you don't see that the sponsor themselves, and this is key, they actually can articulate it in the business plan and actually make it clear to a layman that doesn't do this for a living that here's how we're adding value, X, Y, and Z. Here are the comps that prove it. Here's why we can raise rents or do whatever we're going to do in our strategy. And so if I've got a good sense that they know what they're talking about and there is a true value add, then I'll dive deeper. And then I want to know, okay, the sponsor themselves, what is their track record? Do they, there's a million things I could go through here, but basically, to me, the most two important things is to look for is a value add component to any of these real estate syndications that you invest in, besides debt funds, and operating companies as well. Anything that you want to be able to add value and a margin of safety. And then two, the jockey. Who's driving the horse? That guy can, a good sponsor can take a deal, a really good deal and run it into the, a bad sponsor can take a really good deal and run it into the ground. And a really good sponsor can take a mediocre, or even not that great of a deal and do very well with it. So it's really about the sponsor and the value add component. And there's a million other little things I look for, but if you can get past those two things and learn how to do that, you'll be able to flush out a lot of deals that you should invest in. Because I've noticed as more and more people get into the syndication business, it's more about doing deals and collecting fees than it is actually knowing what a true value add component is and being able to communicate that clearly to me as the limited partner, because I'm going to ask hard questions. And if they can't answer the hard questions and don't respond to my emails because, oh, Hans is going to be a difficult investor, I'm done, right? It's a red flag. I'm the kind that will ask questions up front. I understand the deal and I understand the risk that I'm taking. And a lot of times I flushed out sponsors that way. I'll ask some very good bulleted questions. And if I get vague answers back or get kind of an arrogant response or no response at all, I just cross them off my list because there's a million fish in the sea with these deals, right? So
let me ask you this. So I want the conversation to be additive, right? So we all agree. I think what Hans said is fantastic. Ray, I'm gonna jump to you. Is there anything? What else would you look for in addition to what Hans has said? What do you look for?
So I have three criteria, and I think whether you're the GP or the passive LP, it's important. One, I'm always looking to buy below replacement cost. So that's one of the metrics that I always look at. Two, I'm always looking to see where the rents are relative to the market, and we're always looking to buy at market or below market rents. And number three, it always has to have some sort of value add component, just like Hans said, to cover the downside risk. Those are really the three main things, but 80% of my investment or the passive investments that I have, 80% of it was all the jockey, as Hans said, the sponsor. I want to know who they are. I'm not, if someone's, I get broadcast emails from people trying to syndicate deals that I delete those. If I'm going to invest, it always has to come through a referral source. Someone in my circles that maybe knows the individual or has invested in the individual, then that piques my interest. That's got to be the number one criteria for me. And then it's all about the sponsor. How many recessionary periods have they gone through? What's their background? How have they behaved during those recessionary periods? Have they handed the keys back on a whole bunch of assets, or they've never had a foreclosure? Those are the things that I look at. And then, do they have similar core values as I do? I try to talk to the sponsor. Who are they? Are they ego driven, or are they really low key? So those are all the things that I sort of do to vet out a sponsor and a deal.
Matt, anything you want to add?
Yeah, absolutely. So I rank them this way, right? It's a little different than what we said already, but the same in some ways too. But this is my hierarchy. Number one is the operator, right? Because I find that as we said, a good operator can make a amazing deal terrible if they don't have their eye on the ball and they don't have the training or the mentorship or their own personal skin, whatever it would take to get through a storm that may show up. Not many operators had COVID in their underwriting before 2020, but good operators got themselves through COVID because they were able to pivot, right? And the second thing is the market. We haven't talked about that yet. But where the property is a strong consideration for me, the market that we're playing in, because somebody could have the best deal in the way. A great operator could buy a great deal in a market that's on the way down, and that market will pull that deal down because you can only charge but so much. You can only employ through the employment base of that market. You can only operate in that market. I can't pick that deal up in the operator and put them somewhere else. I am subject to the confines of the market the property's in. And so I need to, as an LP, make sure that market is, on the rise. I like job diversity. So I tend to not invest in markets that are, all one thing, all oil and gas, all tech, all whatever. Not interested in markets, like Provo or something like that, where it's, big tech boom. That's cool. It's a nice wave to ride until that wave's not there anymore. If that market decides to take a hiccup or something like that. So then beyond that is the deal. Because like I said, the first two, the operator and the market, can actually carry a mediocre good deal to really good status, or can pull a phenomenal deal down. And business plan, yes, but nobody's got a crystal ball, and neither does the operator. And any deal that I've ever done as an operator myself or as an investor, at some point, the business plan's here. And for the next 5 years, the operator's going to have to pivot. Something's going to change. Rates are going to come up. COVID's going to happen. The market's going to crash. This is going to happen. That's going to happen. So they're going to have to change their plan midstream. And I want to see a really good business plan, but I also want to see an operator that's savvy and seasoned enough that they can change the plan as the economic tides change.
So let me ask you this, right? So let's talk about, we're obviously an experienced group here. So a lot of this stuff is like second nature in evaluating an operator and their experience. You're looking at a business plan, and I'll start with you, Ray, on this. You're looking at a business plan, and the operator sponsor says, yeah, I have this apartment community. I'm going to take, the rates from X to Y, and I'm going to, renovate all these things. And I'm going to do, improve 100 units in a year or whatever. How would you suggest to someone who is not as experienced to be able to tell what's real and what's bullshit, right? To me, that's a key element.
So first of all, the key thing I would focus on is this their expertise? Have they done other transactions in this niche? If this is their first apartment project, I got a lot more concerns. Two, is this a market that they've already invested in? So do they have resources and a network? Do they have general contractors? Do they have subcontractors? Do they have boots on the ground that can pull off 100 units of being turned over? And then the third thing is, do they have experience in that heavy lift? Because a lot of sponsors could have really put together, as Hans said, a really passive deal, and just really not put forth a lot of effort in adding the value. And if you see that it's a heavy lift, do they have experience on that? And those are the questions that I would ask to vet out whether this is something I want to invest in or not.
Hans, what do you got to say about that?
One thing I forgot to mention, it kind of goes along with what we've been talking about, is skin in the game. I won't invest with a sponsor that doesn't have a good chunk of change in their own deals. And there are a lot of them out there. I don't understand how they raise money. I will not touch a sponsor if they're not putting their own money into the deal, period. I think that shows, lack of confidence in your own deals, right? That's where you should be putting a big chunk of your money. And honestly, it's kind of the chicken or their egg with some of this, looking at a deal and saying, oh, is this true value add? What are the comps? I want to see the comps in the business plan. I want to see that they have thought out a strategy. So yeah, they named 4 apartments in, Kansas City, Missouri. I'm not going to know those apartments, but that they have actually thought through this. There's a strategy. They've laid out the plan. There's not just saying we can raise $200, apartment in rent. And it's actually laid out and it's transparent. And then I'll ask questions around that. And I will also look at their pro forma and their P&L. And this is something that I try to stress to a lot of people that are getting into LP investing. You got to learn how to read a P&L. If you can't learn how to read a profit and loss statement and projections in a pro forma, you shouldn't be investing 50 to 100K in a deal, period. I mean, it's just, you should probably be more, just go to a registered investment advisor and have your money placed in the market, because you've got to be able to assess, and you're not going to be able to do it day one. You've got to take time to practice on these deals and look at a lot of them, ask a lot of questions. And as you start doing that, you start getting a feel for, okay, here are the good operators. This isn't a good operator. This doesn't make sense on this P&L. And you kind of get a sense for it. And it's a little bit of an art, and it takes repetition, and you have to be patient. As I said earlier, you've got to be patient and not try to just get into the first deal you see. So I think it is important to actually look at rental comps and actually ask questions about the P&L and understand that aspect of it. I do dive in that deep when if it's a single asset deal. You can't do that on funds. That's a different model, but a single asset deals, you got to dive in to the projections themselves.
So I want to talk about, you mentioned the skin in the game, right? And there's skin in the game, there's alignment of interest, right? The one thing that I do want to touch on is alignment of interest is important. As we know that for a majority of passive investments, depending on whether they're heavy on fees and making a ton of money up front and on the back end, and you got to know, where is the money? How is the sponsor making money? Is the sponsor making money on the deal itself by just the transaction, or is the skin in the game or alignment of interest more of how much money make on the backside? This is akin to how a financial advisor or whatever charges a commission, whether or not you make money or not, right? So to me, the alignment of interest is always big, right? How much do they stand? If they got money in there, wonderful. How much would they make, or how much would they lose should it not go well? Matt, tell me a little bit about how you do a big volume of deals, and I know that you probably have a sizable payroll and that kind of thing. So what is your focus on, alignment of interest versus skin in the game? How do you manage that, and what do you look for?
I have a different opinion on the skin in the game thing. I really don't. I mean, I've invested with plenty of people that didn't have skin in the game, but I do like dollars in the game, right? But I don't believe that writing a check of dollars is the only way to align interest to a project, right? Certainly there's been operators, I had a guy that wanted me to fund one of his fix and flips, and he wanted me to go second position behind hard money. And he was going to pay the closing cost, which was it was a $600,000 fix and flip purchase. And he wanted to pay like $18,000 at closing. And that was his only check he was going to write. And it was hard money and me behind them. That didn't work because I just didn't see enough alignment. I didn't need to see a check. I just needed to see some sort of a commitment. Now, a larger operator, like myself, again, I payroll. I have a lot of obligations aside from getting my money back or seeing a good return on my cash. I have a reputation to uphold. And the fix and flipper I just talked about was brand new. It was the second fix and flip. Right. So for all those reasons, I just didn't do that deal. But I've invested with people that didn't write a check, but they had some sort of an alignment to the project. The guy that I lent the money to the barbershop on, yeah, he brought a lot of money to the table, but that I didn't care about that. What I cared about is his business was in the building, right? That's his alignment. He's got an operation that is a tenant of this building that he's buying from me. And that's his livelihood. That's his core, and he knew he couldn't lose that to foreclosure to me or whatever, because he's making his money and feeding his family off of that. And syndicators, operators have their, yes, there's bad boy carve outs, and yes, there's not, it's non-recourse or whatever, but nobody wants to give a property back to the bank or have a deal go south or whatever it is. So they have a long reputation to uphold, and whether they write a check or not, if they've got the know-how, which is what I look at more, versus a brand new operator, if they've got the know-how, the resources, the mentorship, whatever, to carry that ship forward. It's not that I don't care whether they have money out of their own pocket, but I look for alignment in other ways, such as reputation, bankability for their future, how many other deals do they have going on, those kinds of things. Because to be frank, maybe the $50K that would take to invest in the deal just isn't freed up at the time. And as you said, Serge, maybe they want to stay liquid for another thing. We also have to show liquidity. two banks, right? So maybe for the liquidity requirements for the deal, they needed to keep their cash on the shelf, right? So for a lot of reasons, they may not be able to write a check, but it's not because I don't know if it's because they don't believe in the project. That could be, and I'll vet that out. But I don't make it just, did they stroke a check or not? I think there's a lot of other ways that they could be aligned, whether they have money in it or not.
Yeah, thanks. Ray, what's your take?
It's a hybrid of what Matt and Hans said. So back in 2009, I invested with a guy that was rather young, not much experience running his own company, but lots of experience in this space. And he brought no money to the table. But I got 85% of the profits and the upside. But he knew a lot about the industry, had a lot of relationships, could assure the deal flow, had all of the systems in place and the right people to pull off. And I had many meetings with him and really got to understand him, his core values, and who he was. So I've done that, but also there are certain instances where I've invested in a debt fund for real estate, and the sponsors have brought in a significant amount of their own equity into the deal. I think it's all driven by, again, your due diligence and your gut feeling and aligning of interests.
Yeah, thanks for that. Yeah, I'm kind of in the same boat, right? I always want to see that the sponsors, how are they invested? Are they invested in the people, or are they invested financially? However they're invested, what do they stand to gain and lose? If it's all upside and no downside, then I'm out. Right. That to me is a critical part. So I think that's why I wanted to distinguish the alignment of interest versus necessarily just capital. Now, if you never invested any of your deals and you're doing something completely different, then I'm out. Right. That's a big part of it. Question came in that I'm going to jump right into is, let's talk about like fee loads and fee structures, and knowing that you can go all over the gamut with that. I'm going to start with you, Ray, on this. What is normal? What do you expect versus what's piggish?
I just think it comes from experience. And if you're relatively new to investing as a passive investor, then you got to put yourself in circles and have people, mentors and others that you can bounce off of when you're looking at an investment prospectus as to what market is. I'm a sponsor myself, and my fees are market rate. So you just got to do your homework, be curious, ask a lot of questions, bounce it off of everyone in your circles, and understand what the typical market fees are. And if the sponsor has got those in the deal, they're market. But if they're excessive, you can quickly, rather from experience, determine that. Typically, like I looked at a deal, an apartment, single asset deal, and the acquisition fee on a $80 million deal was $250,000. And I think that's a fair fee. So it just comes from experience.
All right. Hans, what do you got?
Agree with Ray. On the fees, there is market rate is 1 or 2% on an acquisition fee, and I'm fine with that. But where I have a problem is when somebody's buying a massive deal like what Ray's talking about, and they don't cap it. So there was a deal I looked at a few years ago that an RIA sent me to vet for them. And, the sponsor, who everyone would know his name, was getting paid like 1.2 million day one, right? Because it was a massive deal, and he had like a 1.5 acquisition fee on the entire capital stack of like 60 something million dollars. And I'm like, that's excessive, right? I mean, it's just 1.5% on a $65 million deal or whatever it was. I don't remember the numbers exactly. It was just, I was like, as soon as I saw that, and then I kind of knew who he was already because of my time in the business, that pretty much did the deal for me. But the other thing, fees are important. And I know everyone like stares at fees, just like Ray said, market rate. We spend a lot of time as sponsors looking for deals. I spend all day on my deals, right? Looking for new deals, managing my current deals. That's active income that we're getting paid for the time we're putting in. And so that is very, that's how we make our money, part of how we make our money. But then secondly, what I look for, and more importantly, is the the waterfall of the comp structure in terms of the actual deal itself. In my opinion, I don't, a lot of people disagree. I really, really want a pref. If there's not a pref, there needs to be a very good reason. In other words, I need to get paid a minimum return before the sponsor, not counting his fees, before the sponsor makes return on the cash flow or the upside on the deal. At least give me a minimum 8% or something like that before you start sharing in the profits, right? And so I want a preferred return, and then I want, some sort of hurdle where basically I want to be able to look at it and say, okay, if I'm an LP, as I do better, the sponsor does better. That's what I want to see. That's why I like a pref, because I want to get to a certain hurdle. And then I'm totally fine with sponsors taking 50% after they get me over a certain hurdle. And it all depends on the risk profile of the deal. A development deal needs to have a higher risk profile, so a higher hurdle. A very down the fairway, easy Class B apartment deal in Dallas, Texas, you could have a hurdle of, 12.5, 15%, and then go 50-50 after. And I would be fine with that because it's a lower risk deal if the sponsor has a track record and, and basically has experience in the market. So the comp models just need to align with your interest, is the way you have to think about it in terms of fees and the waterfall.
I want to jump around a little bit here, unless Matt, you got anything important to say on that particular topic?
Just highlighting alignment of interest. I love what Hans said about waterfalls and that kind of thing, because people should look at that as like, that means the more I win as an LP, the more the operator wins. That's total win-win in that. So prefs kind of gone both ways. I've seen deals with prefs kind of like the operator ends up needing to sell at some point just to catch up on the pref or something like that. So I've seen pref deals because the pref go the wrong way, but not every deal does. I get why it's a benefit to the LP. And I like as an investor seeing that. I agree that heavy acquisition fees on the front end and very little, I've seen 2% acquisition fee plus a 90-10 split behind it, meaning like the investors get 90%, the LP, the GP gets 10. To me, I don't see that as much of a line of interest, because all that means is the GP is really out for the closing, and if the GP makes too much of their money on closing and not enough on the operations of the deal, there's just not enough carrot out there for them to stay in and play the long game with me.
Yeah. The only other thing I'll add on that is, I think, I don't know if it's Hans or Ray said it, was the amount to me is on the acquisition fee. If it's, if you're talking about a $70 million deal and it's a percentage of that and it's uncapped, it's egregious, right? If we're in self-storage, so our deals aren't nearly, they're smaller deals. An average acquisition is like $5 to $10 million. So the amounts are going to be, a little different there.
My reasoning on that is it takes just as much work to buy a $20 million deal as it does an $80 million deal. We all know that, right? It's just X and zeros. So
well, I'm going to jump to talk about the waterfall a little bit, right? And this is where, I've seen a lot of deals come through with these really crazy structures, right? You got a Class A, B, C, and this one is in this tranche, this one is in that. One of the questions came in is, how can you tell? And we know that there are some people that playing shell games where one class of investor is actually paying the other class of investor, in terms of preferred return and all that. How can you tell, how that's being sliced and diced relative to waterfall? Let me start with you, Hans.
Yeah. And that's in my training that I did or whatever I put together. I did kind of note that is you want to be careful what class of investor you are. So I think what you're talking about is like you invest more, so you get a higher pref or something like that. There's also preferred equity where you're sitting above the junior equity. So you got to be able to understand what these classes of equity mean. So it's probably not going to be a popular opinion, but you actually need to read the legal docs. And you actually need to understand your rights as the Class A investor or the Class C investor or whatever investor you are. You need to be able to sit down and understand where you fall in the pecking order of the equity. There was a deal I was looking at the other day where they had multiple classes. And what I wanted to understand is that, one got 6 pref, one got 7 pref, one got 8 pref based on the amount of money they invested. So effectively what's happening is the guys that are getting the lower pref have to wait until the guys are getting the higher pref, get their pref before they get a split above their 6th pref. Does that make sense? So basically, I know it's confusing, but you have to get into the details and understand, okay, I invested only 100 grand and this guy invested 500 grand. So I have to wait till he gets his 8 pref before I get a split of my lower 6 pref. You have to know that going in. And so I actually dive into the legal docs. I ask the questions. You have to, and if you're not getting transparent answers, that's a red flag to me. That should be, I don't like deals with tons of classes of equity because it feels like financial engineering to me a little bit. Yeah. What I just described wasn't really financial engineering, but I've seen deals where it's just structured in such a way that, guys coming in as LPs that are just putting in 50 grand in the deal, they're like bottom of the totem pole and they don't even know it. And you've got to be able to pull that out of the PPM, the operating agreement for the limited liability company. And it should be in the business plan. It should be disclosed straight up front, but a lot of times you have to dig into the deeper legal docs on that stuff.
Matt, what's your take?
It's funny, Hans, I love you brought that up because I've seen that, fish hook in the water about people like, I'll pay you 8. You put 250 in, I'll pay you 8. You only put 50K, I'm going to pay you 6. And people think, oh, that's interesting. Maybe I'll, look to get that in, or it doesn't matter. Maybe I'll just put in 50, but people don't realize you're right. You were behind those shares, and you do need to read the legal docs. I like Class A. We do Class A, Class B, and I'm speaking operator now. But we do Class A, Class B, and the Class A is just straight pref equity, which, pays somewhere between, 7 and 9%, depending on the deal. And the B shares, get either a pref or no pref, and then they get upside. The A shares get no upside. So it is like pref equity. It's like you call it mezz debt, but it's not really because it's from my LP investors, not from a third party. The factor there, if I was looking at a deal as an investor, I would make sure the operator is not selling too much of those Class A shares because they can blend out a lot of cash flow and and a lot of deals that we've seen, and again, not naming names, that have gone south recently or about to go south now are ones that there was a lot of that pref equity stuff in second position and very little common equity behind it. And the deal has to do so well to pay out all this pref equity. And it's like the scraps are left to the common shares that get sold to LPs. So I'm very wary of deals like that. So we sell like 10%, I think, of the equity stack, 15% of the equity stack in those Class A shares, and the rest goes to upside. You had alluded to this. I think you were addressing Matthew's question here about operators over raising. And I want to just comment on that briefly. And that is, raising more than they need so they can service a pref during the value add cycle, during the stabilization part of the project. I think that it's interesting. If you've heard the term keeping people, feeding people, and keeping them in the dark, AKA treating your investors like mushrooms, right? Is what you're doing. If you're over raising like that and just paying a pref blindly, it's a way to keep your investors very happy. It takes a lot more courage and a lot more transparency to say, hey, we're going to raise just as much as we need to have a nice operating reserve and enough to buy the property, and that's it. We're not going to service your pref or pretty much give you your money back during the stabilization cycle of the deal. And it requires a lot of transparency. Investors will be nice and quiet and not ask you any questions if you start servicing a nice 6-7% pref the day after closing. But the way that you can tell if somebody's doing that is if that's what their operation plan is, and that's what they do, is if they start servicing a pref in the first quarter on a big value add deal, well, where do you think that money's coming from? Right. It's certainly not coming from the deal if the deal has a big hurdle to overcome or something like that. So I think that the way you can investigate that is by looking at the financials, looking for operators that do send out transparent financials on a quarterly basis. And that's something you should ask during due diligence. Send me a sample investor report on what you send out to your investors quarterly. You show me the P&L you're planning on sending me so I can see where the money you're paying me for my pref is actually coming from versus just coming out of the bank account with money that I gave you.
Yeah, let me add to that.
Please.
Matthew's question. This is a really good question because I think a lot of sponsors do that. This goes back to my point that you need to learn how to read a P&L. So, you can find out after, but the key is to find out before you invest, right? And you got to be able to, you want projections from them that are detailed to the point where it goes all the way from their NOI, shows their debt payments, shows their asset management payments, shows their, interest, whether it's interest and principal on their debt. And then it gets all the way down to their actual pure cash flow on a predicted basis. And if that cash flow is 1%, and then they're telling you year one payouts to investors are going to be 4%. The difference is your own equity being paid back to you, and you just got diluted. So it should be very clear on the P&L, and it should be very clear on the sources and uses statement, which is, I could go into that too, but you really need to learn how to read a sources and uses statement and understand where the money's going.
Yeah, well, I was going to mention the sources and uses and you got to be wary about what they're calling different things, right? It's a XYZ reserve, right? It's whatever. If it's something that doesn't make sense, and this is true if you're buying a house, right? A title company, an agent, a bank, they put fluff, fees on there, and you got to learn what they are and what they're going. I can't tell you how many people my real estate days, I've saved them a ton of money by just being at the closing table and challenging fees, like conveyancing fee of $500, conveying what, right? Where, these egregious fees that just beef up, different individuals' pockets, and you got to be able to read that. Ray, what do
you mind if I hop in real quick? Sorry, Ray, sorry to step on your toes there, but I just want to write on top, honestly, before I forget what I was going to say. The sources and uses in looking at this, the operator is likely not going to show a line item that says pref reserve, right? What they're going to show you, and this is where you need to get really good at reading these kind of statements, as Hans said, is they're going to show an operating reserve, which is just a lump of cash, like call it just in case money, so we can handle ups and downs and operations on the property, perhaps advancing construction if we're doing a construction draw program or something like that. But what you want to do is make sure that amount of money makes sense, right? I looked at a deal where, just for DeRosa, we tend to raise somewhere between 6 to 9%, if the deal's fairly stable, 6 to 9% of monthly expenses. And if you want to put debt service in there too, that's even more conservative. Fine. I looked at a deal, Serge, guy had 2 years worth of expenses as an operating reserve. And it's fairly clear that's what they're going to do. They're not going to say, well, we're going to just pay investors or pref out of this cash. But it's clear that was the intention, because there's no need for that much cash. You don't need 2 years worth of expenses to sit on the bank, sit on the shelf for rainy day money for just in case, right? You got to make sure that these things make fiscal sense for them to raise the amount of cash that they have, and make sure they're not raising too much. Some people look at that, and I've heard operators pound their chest about this. Look at how much extra cash we're going to have, right? Well, that's good, but as an investor, you should actually scrutinize that a bit, because why do you need that much, right? You're actually diluting me by raising more than what you need for the deal, and you're actually enabling yourself to kind of shield me behind a pref and just pay a pref so I don't ask any questions, in that if you've got that much cash sitting on the shelf.
That's awesome. Ray?
Yeah, so just keep in mind that as a passive investor, it's not so much let me rephrase it. You really got to look inward as to who you are. If this is your sort of entree into passive investing, you have to really look and see what your strengths are and what your weaknesses are. If your weakness is reading financial statements and investment prospectus and everything that Hans talked about, you probably don't want to get on your first deal into an investment that's got 4 different waterfall levels. You just can't follow it. This is your first time investing. So you got to go with a more simpler model on your first deal. And then as you become more experienced, then you could follow the waterfalls, read the documents, and become familiar with it. I think that's really key. For me, like Hans has got a bit, he's a CPA. He loves numbers. He can dig in. He's very savvy. If you come from that sort of a background, reading the financial statements is a lot easier for you. For me, I'm not like Hans, so I like simplicity. So if I'm looking at a deal that's got 4 levels of waterfalls, man, my head blows up. I can't follow it, and I'm not willing to invest in something that I gotta really read 200 pages of the operating agreement and the PPM and all that. So just know who you are and invest where you are. Have some strengths.
Yeah, and to that point, it's one of those things where you build your own team, right? You should, if you don't want to read the legal documents, have an attorney read it. It only, you can get an attorney to review something for a couple $100 or something like that. You can get your tax advisor, financial advisor, whatever. Always make sure that the one thing that I've run into in the past is having someone who has a different alignment of interests reviewing your interest in investing in something. Take, for example, if I take my life insurance agent and I show him an investment deals, he's going to say, well, that's really risky and whatever. Here, take a look at this insurance platform, right? Because that's what their job is. But to your point, stick with what you know. If you like, and like same thing with asset classes. I invested in a coffee company, in a ranch community, things that I actually enjoy, that I want to follow. If you're just looking for money and doing different things, that's where you can get burned, right? You chase, like we've had a lot of investors ourselves that say, well, I can get, this pref and this with this company there. And like to what Hans is talking about, if it's a value add, you're not getting cash day one unless it's coming from somewhere else. So you got to ask those questions. And if you don't have the direct experience or expertise, find somebody that does. It's as simple as that. I want to jump into talk a little bit about war stories. I'm going to start with you, Hans. Right, you wanted to share story of how you got into investing in general, and some good or bad experiences. I want to hear some of them.
Well, mine got started, and the reason I wanted to share this with everyone is like, yeah, I'm in a bunch of deals now, and I've done decently well investing, but I started out going completely the wrong way. Like, I made the bad choice day one. I quit my job as I was in consulting. I was a CPA, but I was doing more management consulting work with PwC, and quit my job to go work for a guy. And I was going to fix his accounting. He owned 800 units in the Dallas area. I was going to fix his accounting because it was a disaster, which should have been my first clue, but I was green, right? I was working in PricewaterhouseCoopers. I didn't really know about the sharks in the investment world, and you're at a professional firm like that, everybody's smart and nice. And he was going to mentor me in multifamily, and I was going to fix his accounting. So I basically cashed out most of my retirement money, took the penalty and paid the taxes so I could have money to invest in this deal that I was going to be pseudo involved with. I was on the GP team, but again, first lesson, I didn't have a vote. So I just wanted experience, right? So I had to cash my money out to participate in the deal because I was on the GP team. So I technically had control, but I had no control. Long story short, the deal wasn't going very well. I had probably half my net worth in this deal, which wasn't very much. I don't think it was a ton of money. It was like 100 grand. And basically deal wasn't going well. There's another passive investor that was kind of vocal, and myself and some other investors have been trying to get this guy to hire this management company, would never hire him. And we couldn't understand why, because he was using this one lady that was kind of doing the deal herself and hiring employees. Long story short, turns out, I found out years later, he was having an affair and he married this lady. So myself and another limited partner got voted in by all the other limited partners to take over the deal. And we literally kicked the guy out of control. He didn't lose his comp, but he lost control. Myself and this other guy hired the management company. We've been begging him to hire for 2 years. This lady helped us turn the deal around, this management company, and we sold it for, 24% overall return, which at the time was like, I'm just happy I got my principal back, right? This was in 2011 to 12. So it was kind of like a war zone in Dallas, and, some tough properties we bought for $20,000 a door. I sat on site in the assistant manager's position to learn because I was stuck, and I was in the deal and I had to save my money. I'd quit my job. So I say all this to say, it caused me to be very conservative and to mitigate risk.
I bet so.
Yeah. And to learn risk about what risk-adjusted returns are and how to read legal docs, because I figured out, we sold the deal. I made a little bit of money, but the guy that we kicked out made more than me and the other LP combined on the deal. And by the way, that other LP is now my business partner. So that's kind of what kicked off my career. And you know, my point is it shaped my investment philosophy, and it made me be very careful about who I invest with, the deals that I get myself into. And I actually read the legal documents at a high level, and I know where to look for things now to know that, you know, if shit really hits a fan, do the investors have a little bit of control? You don't have to be able to just kick a sponsor out for any reason, but if they're negligent or doing things, you know, there needs to be a way that LPs can have some say or some vote. So yeah, that's my quick story and why I'm so conservative now, and why I'm, you know, it's very important to me about skin in the game and all those things. So.
All right, who's got I want to get it to open Q&A. Any really good stories within 2 minutes or less from Ray, Matt?
Most of my stories are on the operations side. I've had some fairly benign LP journeys, nothing like Hans did, where that is crazy. There's so many great stories in this business that somebody needs to write a book about real estate stories. But yeah, most of my stuff's GP stuff.
I got a story. So I do some coaching. I don't have a whole lot of time, but I've taken on a few coaching clients in my day. And the one thing that I think can't be understated is comparing passive investors. And this is not because we manage investments ourselves, but we became, Corinne and I basically quit our day job because we realized what we were doing was full-time, right? It started with just buying a single property and trying to buy multiple properties. It can't be understated the amount of work that goes in this. So even if you're an active investor and you're looking at a deal and you're working with a broker to evaluate the projected returns of a duplex or a triplex, you got to put in the work, right? If you're not going to put in the work either at the time of doing due diligence on any acquisition, passive or active, then rely on the firms that will, because it will take up more time. And I've seen some people get seriously burned because they do paper napkin analysis on this is the income, this is the expenses, I'm going to get $300 a month. And then when you realize, no, you're not, then it becomes a headache and you can lose even more money. So that's kind of where I've seen that happen, both in terms of active and passive investing.
30 seconds. I just want to touch on something. So I learned a big lesson. I think a lot of it has to do to mastering your emotions. So my son plays soccer, and I love spending time with him around soccer, anything related to soccer. So I got hoodwinked into investing with a guy that told me that he's going to pull off what the Little World Series has for soccer. And he started name dropping and telling me he knows everybody at ESPN. And so I just got caught up in the emotion. And I shared the investment opportunity with my son. It was like a way for me to teach him about investing. We talked about it, and I just did not master my emotions. And I really missed all the red flags. And so that I lost the money. But I think it's really key to master your emotions. And that's the number one advice I would have, is figure that one out first before you do anything else.
I love that, Ray. That's a great point. You gotta don't get, attracted to the shiny object. That's why I don't care how slick your investment memo is, as long as it says good stuff.
All right. Hans, you want to take a question from Sean?
Yeah. Hey, Sean, how are you? So in my opinion, the two most
read the question first.
Oh, I'm sorry. I guess that would help. Most important ROI metric in your opinion, the COC, cash on cash, IRR, average annual return, equity multiple. How could a sponsor overinflate to dress a deal up? I look at two. I look at equity multiple, and I've got this in my training. I look at equity multiple and I look at IRR, because you could have a 1-year deal that has an insanely high IRR, but the equity multiple is kind of low. I want both. I want a high, I want a decent IRR, but I also want a decent actual absolute return in terms of dollars. Equity multiple, meaning if you invest $100,000 and got paid $150,000, that's a 1.5x equity multiple for everyone that didn't know what that was. So I look at IRR and equity multiple. I think those are the most important two things to look at. And then cash on cash is important on a per year basis if I'm looking for a cash flow investment. For distributions, is the distinction between return of versus return on capital important for LPs? Yes, of course. it's very important. And one isn't necessarily better than the other. It just depends on how the waterfall is structured. Return of, meaning every distribution you get, it's counted as a return of your capital, versus return on means your capital stays the same and you're getting distribution on top of it. And I don't have a problem with return of if I've seen it structured in a way where it's like they pay you an A pref and every dollar above the 8, they start paying down your capital before they get paid anything. That's actually okay because it's a risk mitigation. So it really depends on how the rest of the deal is structured. You can't just look at that. And then what is UBIT? UBIT is the unrelated business income tax, which is on IRAs. A lot of people that are IRA investors don't realize that you actually do pay trust tax on IRA investments. That's the extent of my knowledge because I don't have an IRA, but you got to watch out for that. So actually, I think 401ks, solo 401ks are actually better for syndication investments because you don't pay a UBIT with solo 401ks. But I am not a financial advisor, and I'm not actually a CPA.
Yeah, that's the disclaimer. The one part that I'll touch on, Sean, is how could a sponsor overflate and then dress up a deal, right? So you can make it anybody who knows data knows that you can make data say whatever you want it to say. So it really comes down to the assumptions that are being made. If a sponsor is assuming if the market rent is a stabilized market rent is 3 or 4% and they're estimated 6%, that's one way. If there's so many different ways of getting into the numbers. If the market rent is $200 more than what they expect, and they say, hey, I'm going to over improve it, I'm going to get $250 more, that's a red flag. So
cap rate on resale is the one that I see. The one that I see that gets manipulated the most on these for folks that have syndications out there is they assume today's cap rate will be the cap rate 5 years from now when they go sell the property. Not even today's, but last year's cap rate. Like they brought a property at a 4 cap. And they're hoping and praying that, God willing, and the creek don't rise, that the cap rate will be 4% 5 years from now. Given the interest rate hikes that have happened, nobody in their right mind believes the cap rates will be at 4 or 5 years from now. But look at how great the IRR on that deal is if they're able to sell it at 4 cap 5 years from now. So to me, Sergio, that's where I see the lever get pulled a lot. Quick plug for a friend of mine's book. Brian Burke has a book called The Hands-Off Investor, which is a book written for LPs. And his book talks all about levers that GPs can pull to make their deal look a little more sexy than it really is.
Yeah, that's fantastic.
One last comment. I think one of the key things to look at as a passive investor is, as Hans said in the P&L and everything else that you're reviewing, is the debt service. Look at that cash flow and where the debt service is, and ask the right questions, because if it's a floating debt and you're in 2021, you got to make the assumption that you're going to have interest rates rising, and so you should not be investing in the deal knowing that it's a floating debt deal. So that's really key, is to pay attention to that and ask the sponsor about the debt.
Yeah, can I add one note to that? Because Ray brought up a super good point. Is debt is your biggest partner in these deals, right? They're typically the biggest check. And a lot of people, investors, don't look at how the debt is structured. And that is so key. So the floating rate is important. Like I saw so many deals over the last 2 or 3 years where it was bridge debt on top. That bridge debt was being used to buy stabilized multifamily deals that were 95% occupied. Bridge debt is supposed to be bridge debt. It's supposed to bridge you to permanent debt because you're buying a distressed deal. But a lot of new sponsors are using bridge debt to make a deal work because you get higher leverage. And when you get higher leverage, the return works better, until it doesn't when the interest rates go up and debt matures and values have gone down and you're stuck. And we're seeing this. We've seen foreclosures already. It went around, right? And it was bridge debt that's caused this. So you've got to look at the debt and understand the risk that the debt's adding to your investment.
That's a really great point. Is leverage is your friend in these deals until it is not, right? And that's what gets people in trouble, is levering these things to the gills. If there was one question that I would ask is, what is your stabilized debt coverage ratio And because a bank requires generally 1.25x, and when do you expect to achieve it? Amazingly, I have seen many deals that don't even meet a 1.25 at stabilization in their underwriting. They may have sent something else to the lender to get the loan. Something else is, who is the lender? And to me, I look at it as where is that money coming from? If they won't tell you who the banks are, and you look at who those banks are, it could be, a private lender in God knows where, and you don't know what the terms of that loan, and so you can get into some really hot water there. And
you should ask for the commitment letter. If you're an LP, you should ask for a copy of the if you want it. If it's a part of your DD, I've asked for it and not for a few deals that I've been involved in, and I've had investors ask me for it. And that, not that like day of funding you're looking for a commitment letter, but certainly well before closing, you should want a copy of that. Yeah. And that's, if the GP has their what together, they should be willing to show that to you.
Right. Yeah. Okay. So just jump at some other questions here. Love to see what you all allocate for passive deals in proportion of your net worth. When you release control of your money, you also need to diversify that risk. How do you do that with your passive deals? This is Daniel Del Real. So, for me, it's the way that we've always allocated passive investments is, one is we've reallocated a lot of our retirement funds out of the stock market. So that was the first tranche of money that we moved into. Well, I shouldn't say that. Surplus cash first and foremost. We are personally in a net worth growth mode. So we are looking more for minimal life expenses, and then investing heavily in assets that are going to have a high IRR and equity multiple. Some proportion of that is in, I don't do anything that's really speculative these days. But it really comes down to where you're at in life, and what you're focused on, whether it's cash flow, whether it's equity, net worth appreciation, that kind of thing. You guys have any other thoughts on that?
For me, I don't look at, I just look at, okay, my set aside for my, monthly expenses is X. For my wife and I, we keep 6 months, right? So I keep 6 months of our monthly expenses in savings, whatever that is from the last year, that's what it is. And then it's real simple. Anything above and beyond that, and any cash that comes in above and beyond that through deals or through return of capital or whatever it is, I just cycle back into the machine. So that's about as simple as I make it. I don't do net worth calcs or whatever it is. If my expenses increase, I just up my expense, coffers. But for the most part, just anything that's not in that bucket goes into the invest bucket.
Cool.
I think the key also is to diversify. So whatever monies that you set aside as a passive investor, make sure you're putting it up in different industries, different niches, and you're spreading it out. And if you get a sponsor that you know well, and let's say they know that you have $1 million to invest, and they will tell you, I want the whole $1 million in this deal, run. What you need to do is invest that $1 million in many different deals just to diversify it. It's really key to preserving your wealth as opposed to losing it.
Yeah, that's great insight. Where do you recommend parking your money between putting it in deals? Hans, where do you park your money?
Well, I keep a reserve like everybody for my personal expenses. Then I have money in 4%, 4.5% money markets. And quite honestly, I put a lot of my liquidity in a few hard money funds where I know the sponsors and I trust them. And they're liquid. These hard money funds are paying me 9-10%, and I can get my money in literally less than a week in both of them, unless they're, now granted, if we had some sort of financial crisis, yeah, they might get stuck in there. But for the most part, it's very fast money, turning money, and they can make it liquid. So I have a lot of my liquidity parked in something like that, or money markets, or literally just my bank account, because I got to keep enough for my own deals as well, because I obviously put skin in the game. So.
Hey, Hans, when you do that, are you in violation of any of your liquidity covenants on the loans that you personally guaranteed?
No, I'm not. I'm not signed on as many loans as you are because the way we structure some of our syndications. But
I can comment on that.
I don't have near as many restrictions as you do. Definitely.
Because that's a really key thing for me is I have to sit in cash because banks don't look at your investment in a debt fund, even though you think it's liquid and it's a week, they don't look at that as liquidity. And so
you would go money market, right? You'd go with a money market account or something. Yeah.
So I have a few comments on that. So first of all, when I talk about like, reserve for personal expenses or whatever, that's like, the Matt and Liz Faircloth, business. Then I've got the DeRosa group over here, which has its own cash, its own everything. And so the cash that my company has is what I point to for liquidity requirements and whatnot. So the other thing we do is, and maybe I don't think this has changed with everything going on in the banking industry. We actually just had the line of credit increased, but we have a line of credit with our bank that is the collateral is our company operating accounts. So we have X amount of dollars in our company operating account, and we have a line of credit that's 2X. So for every dollar that's in that company, like they aggregate all of our company operating accounts that we have, add all that number up, that's X. And then I have a line of credit that's 2X, that's just collateralized to our floating cash that we have. And that's a great way to up your liquidity and again, I'm talking more operations side. I suppose an LP could do the same if they want to have access to a line of credit that they could put out of deals. I have some more sophisticated LP friends that do transactional funding. Like they'll get into a deal for a week, make like literally 3-4% on their money in a week, and then get it back out by funding collateralized real estate transactions. So that's something you can do with a line of credit if you have one.
So I'm going to ask the next two questions as a two-part question. So first question is, what are some recession hedge investments? And the other part of this is, with the uncertain economic conditions and all the risk factors at play, what do you currently feel are the biggest risk factors to pay attention to and questions to ask sponsors to quantify their exposure to these risks? Let me start with Hans.
Damn it. You called me on first on that one.
You win.
It's a good question. So I'm going to kind of answer this in one way. So I am not your normal person. I don't have any money in the markets. I think it's a gamble. I think it's a casino. I just don't have it. All my stuff is in alternatives. So, and everything I look at is a deal by deal, sponsor by sponsor basis. And so right now, I'm not investing anymore in the VC PE space because, number one, I don't know the space as well. Yeah, you can make 5-10x on it, but it's much more risky. So right now, with the uncertain economic conditions, I'm not going to necessarily be able to answer his question about the risk factors at play, because if we knew that, I would know exactly where to invest. So what I try to do is invest in recession-resistant stuff like self-storage. We're doing a self-storage conversion. Sergio, you do a ton of that. Multifamily, I'm investing in affordable multifamily plays where there's an affordability component to it. So I'm not investing in AA, AAA multifamily deals that are $3 a foot in terms of rent. And I'm mobile home parks. I love mobile home parks. They're not building any more of them, and it's again affordable housing. So I'm just staying in these very tried and true singles and doubles down the fairway, simple, affordable housing, and recession resistant stuff like multi-tenant, where you don't have one tenant moves out and you're screwed, right? And I'm also investing a little bit in industrial because industrial has been increasing for a long time, and a lot of people don't know this, but because e-commerce requires something like 1.5 to 2x the amount of square foot that normal brick and mortar retail does. So e-commerce requires more industrial space, and e-commerce has been on an upswing, it went up a lot during COVID, but it's still on an upswing and it continues to increase. There's a huge amount of runway still for that. So that for that reason, I still like industrial. But to answer your question, I invest in very safe deals with very safe sponsors and don't try to hit home runs. I don't get too fancy with it in that respect, around the macro side of it.
Yeah, and echoing that, it's really about also adjusting expectations. The overinflated returns that we were getting over the last few years, they're not there as much these days, right? When the interest rates go up, the expectations for returns have to be adjusted as well. everything. I mean, we were in a bull run from 2009. So it's a very long run from an economic cycle. So it's about adjusting expectations there.
Don't say we're due. Don't do that.
No,
I hate that people say, "Oh, we're due for a recession," because
no,
I mean, for a while.
We are in a market adjustment, right? Not correction or whatever. We are in one. We've been in one now. Anytime you have interest rates, people know I've worked at the Fed for a very long time. Market economic cycles is what we evaluate. All right, we are just about out of time. If there's any pressing questions, post them. There will be the recording sent out. I'm going to share the list of folks that joined us. Thank you so much. We will get everybody in touch with the speakers. We'll share ways to follow company-wise, LinkedIn, and that kind of thing. If you got some value, shoot me an email. If you want to see some more topics like this, this is a really good opportunity to get some really strong experts in a room. So we want to provide value as much as possible. So be on the lookout for follow-up, and thanks for everybody for joining us.